fundamental analysis and using the EIC framework. There are two parts to evaluating a stock for investment: stock analysis to establish the fundamental reasons for investing in the particular stock; stock valuation to determine the value at which the stock becomes an attractive investment. Stock analysis requires understanding fundamental factors that affect the earnings of the company, business of the company, current trends and future potential; financial analysis of the company, industry features and competitive structure. The basic premise of fundamental analysis is that investors in equity make an assessment of the business prospects of the company whose shares they buy. If they believe in the earning prospects, they buy the stock hoping for the price of the stock to move up. Investors hope to gain from such appreciation in price. The primary purpose of equity analysis is stock selection. Equity analysis involves studying a range of variables, factors and numbers and their implications for the future potential of a stock. Information for equity analysis is gathered from various sources such as audited financial statements, analyst meetings, plant visits and interactions with the management, industry reports, analytics and representations, government and regulatory publications. Better the quantitative and qualitative understanding of factors impacting earnings, better the estimate of earnings. EIC, Economic, Industry and Company Framework is the commonly used approach to understanding fundamental factors impacting the earnings of a company, scanning both micro and macro data and information. Let us understand how the EIC framework is actually used in analysis, forming a view about the company and eventual stock selection. Economic policy has an impact on the performance of several businesses. It involves tracking taxation policy, fiscal policy, monetary policy, and lastly, the external policy of the country. The economic cycle has an impact on the performance of companies. A slowdown in GDP growth rates can impact investment and consumption-oriented businesses. Revival in economic indicators is tracked by monitoring various indicators. Consider the following examples of constraints that analysts need to be mindful of. Banking industry in India is subject to regulation and approvals. There are restrictions on telecom industry on spectrum bids and allocations. Cement industry incurs huge transportation costs due to the bulk of its produce and geographical dispersion of its markets. This explains why regional costs per bag can vary depending on where the cement is coming from. Sugarcane industry works at high capacity in the crushing season and holds the stocks for the rest of the season. Umbrellas, raincoats, woolens, ACs, festival accessories are all subject to seasonal demand. It is usual for shipping business to find that the economic cycle has turned before the additional capacity is ready. They are saddled with high tonnage during a slack, tend to sell off at losses, and then struggle to meet demand when the cycle turns up. Analysis of company factors encompasses the following: ownership structure, financial history and prospects, capital expenditure, product segments, market share and growth rates, competition, management strategy, risk factors to revenue and earnings, estimates for growth, margins and earnings, price and valuation of the shares. Historical financial analysis is used in understanding the underlying relationship, but recommendations are made based on what is expected, rather than what happened in the past. Analysts follow two broad approaches to fundamental analysis: top-down and bottom-up. Top-down approach involves scanning the macroeconomic scenario and then identifying industries to choose from and zeroing in on companies. On the other hand, bottom-up approach begins at stock selection based on the business potential and its ratification by examining industry and macro indicators.